All right, markets stalling as tech companies, some big ones, miss earnings. 30 minutes until the start of trading. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Tesla disappoints as profits plunge. Ford and Intel are among the companies set to report after the bell today.
Meanwhile, oil surges. President Trump intensifies pressure on Russia to end the war in Ukraine.
And Wall Street bonuses are expected to break records this year as big banks reap profits.
Well, Matt, you mentioned it. The big drag on the equity indexes this morning is Tesla. It is down very sharply here in the pre-market about 30 minutes ago until the start of trading, down nearly 4%, 3.8%. Its profit dropped in the third quarter, and that was despite the fact they had record sales for EVs. Earnings were down a third from a year ago as concerns around near-term growth drivers mount, and all Elon Musk wanted to talk about was his desire to get paid more and have a robot army.
All right, we'll talk a lot about that today. And another big tech company reported disappointing revenue. It is Big Blue, IBM, and its key software business. Bloomberg Intelligence says the results suggest that organic software growth is slowing. And this is, of course, a key concern for the industry as AI eats everything.
Eating everything, but maybe it will save Tesla and Elon Musk as he pushes forward for his robot army. Elon Musk ended the earnings call discussing his $1 trillion pay package up for a shareholder vote. It could give him a 25% take in Tesla. Here was his rationale.
The point is, I just like there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Bloomberg Tech's Ed Ludlow covers Tesla and joins us from San Francisco. Ed, we can talk about the likelihood of Elon Musk going insane and being able to be kicked off in a moment. But first, just the earnings themselves, because it was record EVs. People rushed in to buy vehicles before you had some of the tax credits expiring. Why then did the results look so rough?
Yeah, I mean, look at the stock where it is now in the pre-market, right? Down 4%. That is kind of the level it was holding at in after hours last night when Elon Musk finished his prepared remarks. And in the moment, it was the lack of information. You know, there wasn't this sort of big carrot to keep investors looking to the horizon, any new detail on the big projects around Robotaxi and Optimus, nor was there any sort of them addressing the quarter gone. Record sales, but missing on the bottom line. Consumers rushed to buy Tesla vehicles in the United States before the federal tax credit expired. But what Tesla acknowledged is that tariffs to the tune of $400 million, but generally larger operating costs and a difficult environment were a factor and will be a factor going forward. I guess the one conundrum the market didn't really look to was the impressive free cash flow. But that is, again, a consequence of shifting a ton of inventory in the quarter gone.
So Elon Musk, of course, pushing for his $1 trillion pay package, and really it's him. He's the star of the show here. He's the reason people buy this stock, not because they sell a record amount of EVs, although they did do that in the quarter.
So what happened? We got right to the end of the call, and the CFO clearly had some prepared remarks to encourage shareholders to vote in favor of the package. And Musk basically interjected. He cut him off. But what you just said, the specific wording on pay package, to Musk's mind, it is about voting control because he thinks he needs to have proportionately more voting power to get Tesla to the future that we've talked about endlessly on this program, which is it does not necessarily sell cars to consumers. It focuses on humanoid robotics. And the argument that he and the CFO tried to make is that the proxy or advisory services like Glass Lewis and ISS are missing the point that if Musk is going to achieve that voting control, he will have had to have delivered substantial shareholder returns anyway, pushing back on those advisory services argument that it would be dilutory to the shareholder base for Tesla to reward him with that kind of voting power.
All right, Ed Ludlow covering that story, as always, for us. And you can catch more of him on Bloomberg Tech that kicks off in 11. In just a few minutes, we're going to chat with BNP Paribas, head of U.S. Autos Equity Research, James Picariello, because it's not just Tesla. We also have a surging General Motors on our hands and Ford out with earnings after the bell. We're watching oil prices this morning soaring after the U.S. announced sanctions on Russia's biggest oil companies. Joining us with more is Anne-Marie Jourdain, Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance. And we also have more sanctions coming out of Europe as well.
More sanctions coming out of Europe, the 19 sanctions package. Also, Europe is going to be making the timeline shorter in terms of LNG shipments, natural gas going to Europe to 2027, so bringing that timeline up. But really, as Halima Croft of RBC called us, dropping the hammer, it's the U.S. sanctions on Rosneft and Lukoil. This is a massive amount of Russian oil production. Rosneft itself accounts for about 40% of crude production of Russia. It's also a signal, given the fact, I think, that Igor Sechin is such an important part of oil production in Russia, and he's a close Putin ally. He's the CEO of Rosneft. He's known in Russian media as Darth Vader. So they are sending a big message, and it's the first of its kind during the Trump administration to really go after Russia in terms of blacklisting both these companies.
We have John Malone and they have Sechin, right?
Is that what it is?
John Malone was always called, when I was growing up, the Darth Vader of cable.
I would never want to draw those two comparisons myself, so sure, why not? But you can see the reaction. It is clear.
A little scary.
Yeah, I would probably agree with that. So the reaction is clear, Anne-Marie, up more than 5%, nearly 6% for NYMEX crude. With these sanctions, how difficult will it be for Russian barrels of oil and energy to still find their way to market?
Well, this is why this is a significant measure, but it's not as damaging as potentially it could be, because we would need to see secondary sanctions on those refiners, on those banks that are part of the supply chain if they were to buy Russian fossil fuels, the same way we see in terms of the Iranian oil trade. But this is a big deal because already what we're hearing out of India is top refining executives are saying it is going to be much harder for us to bring those Russian flows into India. The question is, does China come in and fill that gap? If India is unable to do it, it really matters what the next few months look like. But the market reaction shows you that, one, the market wasn't expecting this, and two, there is such a glut right now, everyone was expecting in the market, that they are prepared for maybe some Russian barrels to come off. Also, we have today Ukraine saying it struck a major Rosneft refinery in Russia. So you potentially could see shut-ins in Russia and just more Russian barrels coming off the market with these sanctions.
All right, WTI trading just below $62 a barrel. Anne-Marie, thank you so much. Anne-Marie Jourdain of Bloomberg Surveillance. Now to the financial sector, and this year's Wall Street bonus is expected to break records as bank profits surge. New York State Comptroller Thomas DiNapoli spoke earlier on Bloomberg about the sector growth.
So we always do an annual report this time of year on the securities industry in New York City. And what we find for the first half of this year, profits of $30 billion. So when you consider last year, for the total year was about $49 billion, we could be headed for a record. If the current trends continue, we could be talking about profits of $60 billion this year.
Joining us now is someone who is very familiar with the boom on Wall Street. It's Bloomberg's chief Wall Street correspondent, Sri Natarajan. Sri, maybe this was expected just because the earnings were so solid for these investment banks.
I mean, it was expected as of this month, but if you rewind back to April, this was not the outlook for this year. We were already coming off a very strong 2024, and with what was happening in the first week of April, Liberation Day, all the tariff onslaught that we were hearing about and the immediate reaction in markets, there was real concern and fear that profits would be down, compensation pools will be down, and therefore the bonus pool will be down. Fast forward 6 months, what we have is the exact opposite. Profits are way up, compensation pool is up 10%, and the bonus pool is expected to hit a fresh record.
So who's going to get paid the most? Who cashes in here?
So if you look at across the business lines, obviously where you see the most bonus pools set aside is within the investment bank. And within the investment bank, it's interesting that this year, while we've been talking about the rebound in deal making, it's still not at the level of the craze of 2021. But the group that has done really well is the equities business. If you look at the stock traders, Morgan Stanley, 2 of the 3 quarters this year, they've breached the $4 billion mark. $2 billion a quarter was considered a very good, very solid quarter not that long ago. Now firms are breaching the $4 billion mark with reasonable regularity. That is the business I'll be looking for when you think of the biggest jump in the bonus pool and the happiest folks at banks.
You have a big jump in bonus pools, but to your point about where we come from, there was a moment where we were hyper-focused on costs and costs at banks, and growing costs meant that share prices went down. Has that focus kind of been pushed to the wayside, considering the boom that's been coming back, or is it still a hyper-focus?
No, that's still important, but the point is costs as a portion of your profits is what is important. And when profits are growing the way they're going, when revenue is climbing so much, that expense-based climbing to reward your most successful producers would not look that bad. So they're not likely to be punished in the stock market for that.
All right, fair enough. Sri, thank you so much for joining us this morning. Bloomberg Sri Natarajan. 20 minutes to go until the start of trading. And will we have a second consecutive day of losses? We're down by 0.5% yesterday. Concerns about trade, about a shutdown. Then it morphs into concerns about earnings. We've had back-to-back big tech giants, or tech if you can call it that, Netflix and Tesla, disappoint. That's what's weighing on the NASDAQ 100 futures this morning. It is Tesla, and maybe why Russell 2000 futures are still higher, up about 0.25% with Brent crude, Matt. That move still mirroring what Anne-Marie was talking about, the increased sanctions on Russia.
Yeah, those small caps continue to outperform over the last 100 days. They've beaten large caps. Let's take a look at some of the other movers on our radar. Super Micro Computer came out with first quarter net sales at $5 billion. That misses the $6.5 billion that the street had anticipated, and so Super Micro is duly punished, down more than 8%.
Yeah, everything is priced for perfection, so you don't deliver it. That's what happens. American Airlines also reported a smaller than expected loss for the third quarter. Its outlook topped estimates. The airline expects to reach profitability by year end. 5.5% is the move there, with the luxury travel demand, the business class, what have you, still very strong. And we're going to hear from the American Airlines CFO Devon May in the next hour at 10:30 a.m.
Yeah, American Airlines just adding to the airlines that are crushing it this earnings season. Quantum stocks also crushing it after a report that the Trump administration could get equity stakes in exchange for federal funding. This is a sector that had been, I guess, retracing its moves higher recently until now. Ionic up 9%, D-Wave up 19%, and Rigetti up 11%.
Coming up on the show, BNP Paribas keeps an underperform rating on Tesla. We're going to discuss it with the analyst James Picariello. That's coming up next. You're watching Bloomberg TV.
Let's get to high interest now. We'll look at what's making headlines around the world. Global hedge fund assets have climbed to a record $5 trillion, fueled by nearly $34 billion in new inflows and strong quarterly returns as well. The 3 months through September saw the biggest investor inflows since 2007, according to hedge fund research. Equity and macro strategies led average gains, while crypto funds rebounded sharply. Blackstone's quarterly profit surged 48% as the world's largest alternative asset manager cashed in on a wave of investment exits and new inflows as well. President and COO John Gray spoke with my co-host Dani Berger earlier about the results and his outlook for next year.
The cost of capital is coming down. The Fed's lowering rates. The long end has come down. Spreads have tightened. High yield spreads are down almost in half from their highs a couple years ago. And we've got record highs in the stock market. That is a very good combination for more deal activity. And so if we get a little bit of calm here in the overall environment with this kind of backdrop, I would expect next year will be an even better year for M&A and IPOs.
We're going to have more from Dani's interview with John Gray in the next hour, so stay tuned for that. And Amazon is rolling out a new AI-powered tool for the indecisive customer. The feature is called Help Me Decide, and it will automatically appear at the top of the page after shoppers have looked at several similar items. The feature is rolling out to millions of users before a wider launch. It follows Walmart's recent OpenAI partnership, which lets customers shop directly through ChatGPT.
Good. I look forward to the future where I never have to make a decision again. All right, elsewhere in this market, Tesla's profit plunged despite a record quarter of vehicle sales, and that reflected a strain on its automotive business and near-term growth drivers. BNP Paribas head of U.S. Autos Equity Research, James Picariello, has an underperform rating on Tesla with $307 and on a 12-month price target. James, thank you so much for joining. Can I just get your initial reaction to what we heard from Tesla yesterday?
Yeah, I mean, given the third quarter record deliveries, right, this was supposed to be a really nice quarter profitability-wise into the known margin challenges for next year, right, where we live life without regulatory credits demand, right, because the emissions are getting relaxed in the U.S., and then also, of course, without the $7,500 consumer tax credit for the purchase of EVs, right? Though that spells challenges for Tesla in the medium-term future, right? So the third quarter, right, we had the pull forward in demand. I think we all expected better automotive gross profitability, right, if we exclude the credits. And it simply just didn't come through. We only saw 40 basis points of margin expansion versus the second quarter, which was a very much challenged quarter.
But my question, I talk to Ed Ludlow about this all the time, and I ask, who cares about car sales at Tesla? This is a $1.5 trillion company. That's not a car company's market valuation.
That's right. The punchline to my price target valuation, which is about 30% below the share price, is that 75% of Tesla's value is tied to robotaxis and the Optimus robots, right, humanoid robots. That said, there is strong directional correlation to the stock price and automotive gross profitability. And that's, I think, expectations, certainly my expectations are for the gross margins for auto to come down in next year. Consensus for free cash flow next year is just over $4 billion. I'm just barely above break even, right? So there's a massive gap in the potential downside for next year. And
which is why, because everybody who wants an EV has one. The kind of people who buy EVs don't like Elon Musk's politics. They haven't put out anything new other than the Cybertruck since like 2010. I mean,
yeah, to Tesla's credit and what I have in my model, I do have volumes quite resilient next year, despite the $7,500 tax credit going away. And that's because of full self-driving, right? I do think Tesla is far ahead of the competition for their hands-off and soon maybe eyes-off driving capability. And so I do think that is the driver to demand, but it's going to come at a cost, right? Pricing will come down, and the early commercialization of robotaxi and Optimus is going to have costs associated with it, and that's what also drives lower profitability.
I mean, you saw that in this quarter, right? Like there was a really big hit on operating expenses because of the AI. But if Tesla is viewed in this market maybe more as a tech company, even though your price target doesn't see it that way, we've seen other tech companies be rewarded for spending more. The more you spend on AI, the more ahead you get in the race of whatever's going on. Does Tesla not get that benefit of a doubt that it needs to spend in whatever this AI future is going to look like?
I would say they get a substantial benefit of the doubt. What I've done is taken a look at the Mag 7, right? The Mag 7 group, which Tesla is of course a part of. The average Mag 7 margins are 30%. Plus or minus. NVIDIA is the highest margin at around 60 or 65% EBITDA margins. Tesla is going to be at 15% next year. And if you fast forward to what their 2035 version looks like, right, which I'm giving them substantial success in that view, their margins are still only around 25%, which would be the lowest among the Mag 7. So I do think Tesla's getting a lot of credit already as a tech company.
Can I ask about Ford? It's coming out after the bell. You have not got an outperform on that stock. You do on General Motors, which obviously, the stock crushed it over the last couple of sessions. But year to date, they're still like neck and neck at 25, 26%. What do you expect from Ford?
Yeah, the issue I have with Ford is valuation, where they're trading at a 4 to 5 times PE, price to earnings premium, versus GM. And typically they trade at a 1.5 turn premium. So the valuation is already stretched, and I would not expect tonight for a significant guidance raise from Ford. We did see one with GM, right? And of course that reflected in the stock reaction.
What's the problem? Why can't Ford? Because they make expensive big trucks too.
Yeah. So for Ford, they have an aluminum supplier that they're specifically exposed to. They had this aluminum supplier had a plant fire. That we estimate is going to drive almost 40,000 lower volumes in the fourth quarter. So that's going to be, kind of offset. I would expect Ford to have a better tariff outlook. GM also shared that. Yeah. So I think that's a positive for Ford, but then that gets offset by the fourth quarter aluminum supplier.
Were it not for the fire, James Picariello there of BNP Paribas talking to us about cars. I hope you come back because I like to talk about cars. I will today speak after the close with the CEO of the Ford Motor Company. Jim Farley joins me and Romain Bostic at 4:20. This is Bloomberg.
Look at some of the movers on our radar here. Just 5 minutes to go until the start of trading. T-Mobile gained 1 million new phone subscribers in the third quarter and raised its outlook for the year. It's working with SpaceX on direct-to-device services, but shares down 1%. Southwest Airlines, they posted a surprise-adjusted profit in the third quarter after implementing a new fee for bags. Those shares up just under 1%. And Honeywell raised its full-year profit outlook as it plans to spin off its advanced material unit later this month. Shares up 4%.
There's so much going on today. There's a ton of earnings news.
I think it's the second busiest week for earnings this week. So yeah,
we're in the heart of it.
We have the big tech giants next week, so it's going to get even crazier.
All right, less than 4 minutes until the opening bell. We're going to kick off trading with Ann Berry today. Talk to her about those big tech misses and bring in Anurag Rana from Bloomberg Intelligence as well. This is Open Interest. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We've got a ton of earnings news out today. No shortage of geopolitical tensions simmering as well. And you have S&P futures actually coming up into the green, but really little change here. NASDAQ futures, very little changed as well. And this has been a theme. We haven't really broken out of a range that we got into last week. We did have an amazing, obviously, Monday, but we sold off yesterday. And right now we hear the opening bell in New York Stock Exchange, Energy Vault, enabling a renewable world. This is a company that you would expect to be absolutely crushing it as we need energy from anywhere we can get it for AI. They had a good year so far. I think they're up 40% year to date, but over the past 5 years, down 65%. Down at the NASDAQ market site, you've got Forbes ringing the bell. I believe that's Moira, Forbes herself. I don't know why. There's some kind of anniversary. The most powerful women's list, and that's why.
In sports, and I think they had an event with a lot of athletes at it who were all very impressive. I wasn't there. I saw photos of people there. It looked very cool.
There you go. There you go.
A not cool day for Tesla, if I can make that horrible segue. Its shares are down 4 1/3%. Their profit dropped in the third quarter. That's despite the fact that they had record sales. Earnings are down 30% from a year ago. Matt, the problem is that they're spending a lot on AI, so margins don't look great. They also cited tariff concerns too. All of that weighing on the shares this morning.
Yeah, IBM also reporting disappointing, for IBM, it's revenue that disappointed in its key software businesses. Bloomberg Intelligence says the results suggest that organic software growth is slowing, even at Big Blue. And I think that's interesting as we often hear concerns about AI eating software's lunch. Joining us now to talk a little bit more about this and really the whole tech space is Bloomberg Intelligence senior analyst Anurag Rana. Anurag, in terms of IBM, what is the problem specifically?
you could say there was a modest deceleration in a couple of the units, and Red Hat came in slightly lower than where consensus was. And there's another segment called transaction processing, where everybody was thinking it would turn around this quarter. That was also in the red. So those two things, I think, are a bit concerning. On the good side, I think free cash flow is really good. That was a big positive.
Even so, you're seeing a lot of quantum stocks rally today, Anurag, on this news that maybe the Trump administration is going to be taking stakes on them. Does IBM not have that as part of their business? Could IBM be a potential contender for this? And if so, why are shares down still nearly 5% if that could be in their future?
That's actually a very good question, and I don't think a lot of people are thinking about it that way. IBM has a good quantum practice. I think they're one of the early ones in the area. In fact, all the big companies, all the hyperscale cloud providers have a good place in quantum. But at the same time, it's not a pure play. What we are seeing right now is stakes in a lot of the pure play being talked about, and I think those are the ones that are getting the lift at this point.
When we look at the tech earnings thus far, Anurag, and talk of earnings season was that the beats rate was amazing, but how do the tech earnings or the companies that you follow specifically seem like they're doing in the third quarter?
See, you have to bifurcate it in two groups: the ones that are dealt with AI infrastructure, and the other, all the other ones. It's all the other ones that are having a negative reaction. If you look at Roper, for example, right now, it must be down 6.5%. They just announced a slowdown in organic sales growth also this morning. We saw the similar numbers from Salesforce, from Workday. Accenture's consulting business is weak. So anything that's non-AI infrastructure driven, that is not doing well, while the AI infrastructure play is well. So I think the world is completely divided into two buckets at this point.
Anurag, we had Workday on the program yesterday. You and I discussed it, but software, enterprise software, be it Workday, be it Salesforce, I mean, it has gotten so punished in this market. The idea being that AI will completely disrupt their businesses. These executives are steadfast that no, that is not the case. They are adopting it, and they will not just weather the storm, but lead the advancements in AI. Are we actually seeing that play out yet? For these software companies, is AI yet a meaningful part of their revenue?
No, they're not a meaningful part of their revenue. And in fact, it may not happen for a while. Software by itself should progress in the nature of, evolution of functionality. So AI is just part of it. But when you think about the software landscape, there are two things you have to think about. Is this a structural problem or this is a cyclical problem? We are in the bucket that this is more of a cyclical issue, and people like OpenAI are not going to go out and disrupt systems of records that have been around for a while. Somebody like an SAP, for example, that's been around for a while. Workday, same story.
But why? I mean, if I get a good artificial intelligence woman or dude on my team, can't I say, hey, go make me some payroll software, take care of my health insurance, do my scheduling, like everything.
Yep.
Why would I have to buy it from some other company that has a silly name?
Yeah, it's okay if you are a 5 or 10 person, shop or a pizza area. But if you are a large multinational that has to sign up for, Reg FD and going out and, doing compliance and, accounting, you're not going to go out and leave it to an LLM. You're going to use a system of record that has been housing your data for 30 plus years. It's not going to be that easy to get rid of that, especially for large enterprises. And that's where most of the money comes from, people like SAP and Workday.
All right, Anurag, thank you so much. Anurag Rana of Bloomberg Intelligence. Is it the names you take issue with, the silly names? Is that the problem?
Snowflake, MongoDB.
Yeah, but you remember them better, right? Maybe it's fantastic marketing to be called Snowflake or MongoDB.
No idea what they do. They all just provide solutions, right?
Yes, everything just provides solutions. Okay, let's get a check on the stock market right now, about 6 minutes into your trading day. And we go back and forth, whether it's gains or losses. At the moment, we're looking like gains, up 0.1%. We fell yesterday after consecutive days of gains. So do we get back to a momentum trade that's been really struggling? In fact, this week, if you were to buy momentum stocks, that would have been the worst performing strategy of all the factor strategies like value, volatility, et cetera. Doing the best in terms of points moving is Apple and Broadcom. You just got a lot of the Mag 7 here. Apple, Broadcom, Amazon, Alphabet. Some of them suffered yesterday. Meta's in there too. To the downside, though, it shouldn't be surprised. It is the unloved child, the ugly stepchild, whatever you want to call it, of the Mag 7 today. It is Tesla. After earnings that showed showed some real stress, be it in operating expenses or a tariff hit. Shares down 5 1/3%. And of course, we were just talking about IBM. That comes up second on the list as the biggest drag on the indexes. For the sectors themselves, you're going to get this push and pull between this tech doing well and IBM and others falling. And overall, that's resulting in a tech index that's little change. It shouldn't be a surprise at what's at the top of the pile. It is energy. Oil is up 5 to 6% this morning after increased Russia sanctions coming from the U.S. Consumer discretionary, that is at the bottom of the pile, but just consumer discretionary and healthcare are lower. The rest of the sectors into the green this morning, Matt.
All right, so we should be set up, at least from the industry breakdown, for gains. Coming up, Ann Barry of Threadneedle Ventures joins us at the desk as big tech misses mount. This is Bloomberg Open Interest.
Let's look at some top calls this morning, some of the analyst action that we're watching. First up, Newmont gets an upgrade at Scotiabank. The analysts point to higher gold prices and say that they expect stronger operating performance ahead. Those shares up 1 1/3%. Next up, Morgan Stanley upgrading Lending Club to a buy. They raised their price target to a street high of $22. It's trading just below $19. The analysts say that the company now has more ways than ever to expand its profits without facing a punitive accounting rule. He expects the company to see faster profit growth and stronger returns next year and beyond. And finally, Core Scientific, that gets raised to a buy at Roth Capital Partners. The analysts citing growth expectations that shareholders will reject the proposed merger with CoreWeave. Shares, though, unable to hold on to gains, just slightly lower. Matt.
All right, let's talk about some of the bigger tech earnings that came out. Joining us at the desk is Threadneedle Ventures founder Ann Barry. And we've had big gyrations in this market with momentum trades like AI losing steam. Earnings misses seem to be piling up here, even though we had such an incredible beats rate thus far.
Yeah.
And what's your, first of all, welcome.
Thank you.
Thank you for joining us.
Good to see you both.
What's your take on the misses that we've seen? Are they, is it indicative of so many cockroaches, or are they idiosyncratic issues?
Let's hope it's not cockroaches in AI, because so much is now depending upon it. Let's hope that's been left with, subprime auto loans. I think expectations were extremely elevated for this quarter. There's no getting around it. But what I do think is interesting, Matt, is when you look at the different reasons for the beats or the underperformance, they're pretty esoteric by company. And I think this is where we start to see that the AI trade isn't monolithic, and that the market really has to start drilling down to why is IBM different from NVIDIA? Why is that different from some of the other big tech names?
Well, if you look at someone like Tesla,
yeah.
One of it was the AI spend, but another part of it was tariffs. And they're not the only company to cite tariff issues. We had Mattel earlier in the week, toy companies obviously very exposed. Considering a lot of companies were able to front run some of the tariff issues, is now kind of the period where we're finally seeing some of the stress filter through?
I think we are maybe seeing it filter through. Mattel actually is a fascinating. Can we just talk about Mattel for a second? Here's why I found that one fascinating. If you look at Walmart, Target, the big retailers, last quarter is the time they place their orders for toys to sell in the holiday season. So Mattel, we always knew there's going to be a tariff issue. There's a second issue there I'm looking at, which doesn't mean the big retailers are expecting weaker holiday sales than expected. So the pieces of the jigsaw puzzle are coming together.
Wait, what's the second issue? Because we know you don't need 30 dolls. You can just do with one or two.
Well, didn't President Trump actually say that? In fact,
yes.
So you guys are on the same page. But so the first one is around tariffs. The second one is, fundamentally, what are the biggest retailers with the biggest insight to what consumers are feeling, anticipating for this holiday season? That worried me a little bit. But yes, I think we're seeing tariffs come through. We're seeing people being much more transparent about where they're seeing softness. Hilton was another one, right? Saying we're seeing U.S. demand down, offset by international growth. This is the earnings season where people are having to provide real detail. They're going back to providing guidance, and they've got nowhere to hide at this point. There's enough clarity.
Can we just, I don't want to take this too far off the tech path, right?
Okay.
But
are we going off the reservation now?
We have, Ann and I have a special interest in toys. And Well, Hasbro, right?
Yes,
because both
okay.
of us have interviewed Gina Getter.
That context is so important.
That is very odd.
We've both spent time with the CFO of Hasbro, and they are crushing it. Look at this chart. Hasbro is up 40% year to date, and Mattel is basically treading water. Why are they doing so much better?
Well, I think Hasbro has been leaning a lot more into this adult affection for collectibles and toys, more so than Mattel. So when you look at the portfolio that Hasbro has, I think they're slightly more skewed to that. And I
Dungeons and Dragons,
exactly.
Magic the Gathering.
Exactly, the card games, versus, Fisher-Price, for example, or Barbie at Mattel, which did see that blockbuster with the movie. But they sort of set the stage for IP monetization. Hasbro sort of seen them and raised them. I think that's how that's gone so far.
It feels just like real dispersion. That we went from an environment where, oh God, everybody is going to be in trouble because of tariffs.
Yeah.
To actually, everybody is okay. To now, to your point, you have to actually look at the details and figure out who's winning and who's not winning. How much does that mean you can invest at an index level right now versus individual companies? How does that change things going forward when you're thinking of how to actually be involved in this equity market?
Well, I think the index level has been problematic for a while just because of the sheer level of concentration we've seen in these biggest tech companies. But I'll give you an example because I know Matt wants to bring it back to big tech. Now that we've gone to toys, let's take an example of unpacking the AI trade. Let's take IBM, for example. I know that's one you're interested in. IBM right now is trading at north of 4 times price to earnings to growth ratio. Right? You look at that and say they had actually a pretty decent quarter. Their cloud growth wasn't quite as expected, although healthy teens. And you say, well, do I go and do that? Or do I go and continue to invest in NVIDIA at 1.5-ish times price to earnings to growth ratio? That's where I think it gets really tricky, Dani, because the valuation spread we're seeing right now is incredibly dispersed.
Let's talk for a moment about Netflix.
Yes.
Because obviously the shares have run into some trouble lately, but they've done well over the last 5 years, up 130%.
Yeah.
I heard someone say yesterday, it's not about Netflix versus Disney or Netflix versus, Amazon or Netflix versus Apple TV. It's Netflix versus YouTube.
100%.
On a channel on which you're fairly popular yourself. What do you think about that battle?
So I think that they're going to play to 2 quite different audiences. And this is where I think Netflix is going to be a very credible competitor for YouTube over time. And I say this, I'm holding my nose and buying more Netflix stock because it is still objectively expensive. I do think in the world of more AI slop, people are going to look for destinations where they really want higher quality, curated, high production storytelling. And I think Netflix is trying to find lots of different ways at the moment to make sure it's the ultimate destination where you and I can go find it. It's the partnership with Spotify to try and get very popular Spotify podcasts turned into really high quality video content. I think that's important and on point and on trend. If you look at what they're doing in games, we just talked about Hasbro. Netflix has just got a partnership announced with Settlers of Catan, right? The board game. They're really trying to figure it out and they're being more creative, I think, than others. And by the way, AI has run through their blood, whether it's the algorithm or that's generative, for much, much longer than the other players.
YouTube is crushing it. I mean, I have both.
Absolutely.
But
I have both.
But one thing YouTube has is I don't have to pay for YouTube. I can just log on and watch an ad version of it, or not log on rather, and just watch an ad-supported version of it. More of that is popping up. What's the other one? Tubi, I think.
Tubi, yeah.
Is free too. Are these real threats to Netflix? Does Netflix need to come out with some free version supported by ads?
Well, it's got the ad-supported tier, absolutely.
Right, but a free tier with advertising.
I think about this in a slightly different way, which is think about the apparel sector. Do you want the Gap? Do you want Old Navy? Do you want Gucci? Do you want? I think of Netflix as the luxury equivalent in a world in which content is now purely a consumer product, it's consumer tech, and there are going to be tiers, and depending on what you want to go shop for, in some cases you'll go to YouTube for the lower end stuff, and in some cases you want to go luxury and you're going to go Netflix.
Yeah, be better than the Gap. I guess.
I think of it differently. We don't have to get too deep into this, but I want Aero Leathers. I want Eastman. I want the real McCoys. These are actual luxury products, not just brands slapped on plastic made in China, but we don't have to get too deep into that.
I was going to ask where are you going for those things, but yeah, there's definitely
you got to go to Tokyo, you got to go to Sheffield. All right, Threadneedle Ventures founder Ann Barry there talking to us about the market. We've seen some real gyrations here, and we're focusing in on what's driving that and earnings season, of course, as well.
Yeah, speaking of where you go to shop for things, how about Nike? Coming up, we're going to head to Nike's headquarters. We have a behind-the-scenes look at its new products and new strategy. Stay tuned for that coming up next. You're watching Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. We saw futures down, and we're looking now in the cash trade gains on the major indexes. The S&P 500 now up about 0.5% at 67.29. I believe the closing high is 67.53. The intraday high is about 67.62. And I know Jonathan Krinsky over BTIG said if we get above 67.62, then we're off to the races. But if not, we remain range bound here. The Nasdaq up 0.5% at 25,000 even. Take a look at some of the individual movers to my left. Nvidia, one of the big reasons for the gain, up 0.5% right now. Tesla, obviously the big miss. It's a drop of 4%, but Tesla's only worth $1.5 trillion only, right? Not even. And Nvidia is worth well over $4 trillion. American Airlines adding to the airline successes that we've seen from Delta and United. Southwest actually getting punished in today's market after its earnings report, down 4 2/3%, I should say. And then we have Las Vegas Sands gaining almost 10%, so adding a tenth to its market cap, and Warner Brothers Discovery up about 2% right now, 1.8%. Dani?
All right, shifting gears to Nike, Matt, because it's been 1 year since Nike CEO Elliott Hill took the helm of the world's largest sportswear company, unveiling a suite of new products to usher in a new era. Bloomberg's Romain Bostic spoke with the key players of the turnaround initiative.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
All told, more than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab.
This is the home to dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new Chief Innovation Design and Product Officer. They are two of the key players in CEO Elliott Hill's full court press to reinvigorate growth following former CEO John Donahoe's reign. It was a tenure that saw annual sales begin to drop in 2024.
We're going to obsess sports. I think that's been since Elliott returned. The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. Honestly, today it's just a more modern, sophisticated incarnation of what Bill Bauman was doing in his lab, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka.
It's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
And that was Bloomberg's Romain Bostic covering Nike out of Oregon.
Yeah.
Are you I mean, you're an athlete.
I'm not. I have like every kind of pair of shoes. I have Ons, I have New Balances, I have everything except Nike.
Oh, really?
Yeah, well, I mean, they have. I mean, to Romain's point, they've been lacking behind in innovation. I don't get my tennis shoes. I get those from New Balance because they're crushing it with tennis shoe technology. Running, you have Ons and those kinds of competitors that are doing really interesting stuff. Maybe Nike will catch up, but for now, I don't have any.
All right, I just have like a 20-year-old pair of Prince squash shoes. Coming up in the next hour, Blackstone's John Gray on concerns in the credit market, Carin of Fiduciary Trust on market fragility, and American Airlines CFO. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Losses to start turn into gains. We're up by a third, snapping yesterday's losses, pushing for the green despite some weaker earnings this morning.
Some breaking economic data crossing the terminal. We actually are getting economic data right now. We didn't get initial jobless claims as we normally do on a Thursday morning at 8:30, but we are getting existing home sales right now, bang in line with expectations at 4.06 million units. Let's break down the data with Michael McKee, Bloomberg's international economics and policy correspondent. And are you surprised? I mean, I guess they matched the survey. What does this mean?
Well, this data is produced by the National Association of Realtors, so they can't. It's alternative data, and it doesn't get affected by the government showdown. We're up 1.5% to a 4,060,000 pace on the year, which is slightly above where it was last month. So that's good news. There were some more homes that went on the market. Of course, this is September data. Everybody wants to sell their house before school starts. So that may have been some of the motivation for it. It's the fastest pace of sales in 6 months. So there's some good news there as well. The month's supply doesn't change, though. We still have 4.6 months worth, which doesn't suggest that they're making progress on that. And we also are seeing single-family homes up by 1.7%, while condos and co-ops, multifamily homes, no change at all. So not a lot of building, not a lot of additional properties going on the markets. Basically, at this point, people still sitting still. Little change on the month is what you'd say.
I guess as every piece of data comes in now from private companies, it seems to be of more importance. Maybe this isn't going to move the needle that much because it came bang in line. But what does the Fed turn to right now? There was this story out there yesterday that they lost access to private payroll data from ADP. So what is the Fed looking to in less than a week to go for its decision?
Well, they're looking at just about everything you can find on Matt's favorite page, which is WSL. ALTE, alternate data, Bloomberg's long list of the available data that's not government data for you. But they're trying to put it together a picture based on sort of point-a-list would call, a lot of points, and try to put it all together. They're looking, obviously, tomorrow at the CPI report. They're looking at other data sources. We do get the raw data on jobless claims this afternoon. It may not be adjusted exactly the same as you get from the Labor Department every week, but we can adjust it pretty close and have a pretty good idea of what jobless claims are doing, and the Fed, I'm sure, can do that even better. They did lose the ADP data. Not sure why. ADP's not answering the phone. And so that's one less set of alternative data that they have. But there's a lot out there for them to try to get a fairly good picture of what's going on.
So basically, you and all your economist friends just have to do more work this week to understand what initial jobless claims say.
Yeah, exactly.
Well, we thank you for your service, Mike. Wonderful to catch up with you. That is Bloomberg's Michael McKee. Turning back to earnings, where we are seeing data. Third quarter results are off to a mixed start. Misses have started to pile up for some companies in the tech sector. We caught up with Ann Berry of Threadneedle Ventures earlier.
When you look at the different reasons for the beats or the underperformance, they're pretty esoteric by company. And I think this is where we start to see that the AI trade isn't monolithic and that the market really has to start drilling down to why is IBM different from NVIDIA? Why is that different from some of the other big tech names?
Let's continue the conversation with Carin Pay. She's head of portfolio management and equities at Fiduciary Trust International, a Franklin Templeton company. Carin, thanks for joining us. Wonderful to see you this morning.
Nice to see you.
I wonder if some of these big tech losses are instructive. If you have someone like Netflix that, I know there's some weird tax stuff, but basically comes in line and the shares are punished. That Tesla comes out with record EV sales and shares are punished. What does it tell you about how fickle this market is this earnings season?
Yeah, I think it comes down to the level of expectations, which has been very, very high. So I think that with valuations at high levels, the market at 23 times forward earnings, a lot of good news has already been priced in, coming into this quarter. So it's almost sort of set up for any potential disappointments having a much larger impact on companies.
Although we've had a record number of beats, obviously we're early in the season. I think only 131 companies have reported out of 500. And if you look at the growth, the market the street was only looking for 7.7%, I think, on Friday, and we're at 13.25% now. So we're gonna crush expectations, right? I mean, it's set up to work out that way.
Yeah, so I think we've seen volatility pick up in the market definitely over the last couple of weeks. And earnings revisions, earnings trends are, I would say, for the most part, beating expectations. But I think that, it is a matter of the combination of high valuations and sort of, we're almost getting back into that era where could be whisper numbers or, just sort of where investor sentiment is that could be a little bit more skittish these days as, there could be some other concerns that are worrying investors like credit concerns.
Just to underscore this point, Kevin Gordon of Schwab had the statistics. So for this earnings season, companies who are beating on EPS are underperforming the S&P 500 by 0.35%. So they're beating and then they're underperforming, and it's the worst spread since the fourth quarter of 2020. That's also translated into momentum doing really poorly. So the kind of momentum factor, which has dominated this year, is the worst factor so far this week. To you, is that a trend change, or is it just a pause after a run-up?
It's hard to tell at this point. I mean, it seems like it's a pause, right? We've seen very, very strong momentum coming into this quarter, so it's not surprising to see some reversal of that. But I would say that, at this point in the market, it does feel a little bit like, sort of 1999, where you have a lot of very high expectations as it relates to AI. The markets have been talking about, just a huge potential, right, that exists in the AI opportunity. And I just feel like everyone from fixed income managers to my mailman are talking to me about AI, right? And so there's a lot of that momentum that has been built into the market. And when you have a little bit of sort of, nervousness, it could easily kind of reverse in the short term.
The shoe shine boy, I think, is what someone used to talk about.
I thought it was like a cab driver. When the cab drivers talk, is it the shoe shine boy?
I think, but maybe I'm just remembering that Gary Coleman movie about trains. In any case, I want to ask you about the Fed, because tomorrow we will get CPI, and we're expecting to see 3.1% on the core, which is obviously far above the Fed's target, and yet they're still expected to cut. Does it matter what inflation is for this Fed?
It does seem as of right now, market expectations have it pretty much baked in and priced in for another cut in October and also another one in December. I think that with the labor market slowing down, that does give the Fed a little bit more room to cut in response to that. And so they're a little bit less sensitive to some inflation data. But I would say that inflation data has been relatively sanguine, benign, so to speak, and that gives the Fed a little bit more breathing room as well.
But it's so high.
Well, high is relative.
Right. I'm saying it's 50, 60% higher than the Fed's target, right?
Well, I think that it's still within their band, right? So I think that they can look to the labor market, which is, so they have two sort of factors that they look at. And I think with labor markets weakening, with the jobs numbers, I think it's a little bit cloudy at this point, but the trend has been weakening. And I think that gives them a little bit more room.
All right. Carin, great to have you in the studio. Thank you so much for joining us. Carin Pay there of Fiduciary Trust International, a Franklin Templeton company. Let's get a check of what's going on in the markets right now. We are looking at gains after a rough session for futures. S&P 500 right now racking up a gain of almost 20 points at 67.18. The NASDAQ up almost 100 at 24,975. And the 10-year yield holding below 4%. As I think, obviously, on this screen, the notable move is Brent crude. And we haven't talked too much about that. But
we haven't. It exacerbates inflation concerns. By the way, it does appear that the shoe shine boy giving you tips for stock picks is like the sign of the market top.
Yes.
People have said taxi cab driver, though, in a quick Google, so I'm not going crazy. But historically, it has been the shoe shine boy.
Well, there aren't really shoe shine boys anymore, right?
They're not really cab drivers anymore.
Drivers, yeah.
When the autonomous Tesla driver tells you to buy stocks, and you're in trouble. Okay, look at some of the single movers this hour. Tesla's profit, speaking of which, dropped in the third quarter despite record EV sales. Earnings down 30% from a year ago with growth concerns, AI spending concerns, and tariffs weighing on them.
All right, and IBM reported disappointing revenue in its key software businesses. Bloomberg Intelligence says the results suggest that organic software growth is slowing.
And Super Microcomputer, once a darling of the AI trade, given it's a provider of servers, said it expects revenue for the first quarter of roughly $5 billion. That falls well short of analyst expectations, missing by $1.5 billion. Coming up, Blackstone reports surging third quarter profit. We're going to bring you my interview with President and COO Jon Gray. That's coming up next. You're watching Bloomberg TV.
Let's get now to high interest. Look at what's making headlines around the world. We are going to bring you, at some point, a live shot. There you go, a press conference with the U.S. Attorney for the Eastern District of New York, along with FBI officials announcing details stemming from 2 indictments involving illegal gambling schemes. And I guess the District of New York is going to bring a case against Miami Heat guard Terry Rozier and Portland Trail Blazers head coach and Basketball Hall of Famer Chauncey Billups. They've been arrested in a federal gambling probe tied to organized crime. Prosecutors allege high-stakes poker games in New York, Las Vegas, and the Hamptons were rigged using tech-enhanced card shufflers, hand signals, and hidden cameras. The FBI plans to announce 31 arrests, and I can't wait for the movie. Wells Fargo's Mike Mayo is slamming Citigroup for naming Jane Fraser chair and giving her a multi-million-dollar retention bonus, calling it pay before performance. He said Citi's weak efficiency and subpar returns, coupled with the ongoing Fed consent order, shows the bank has not yet resolved core issues and continues a long tradition of paying for underperformance. And Mayo is notable as one of the analysts who really speaks truth to power. While Blackstone's third quarter results topped expectations, analysts are highlighting some uneven spots. A KBW analyst flagged lighter than expected fundraising in private equity and real estate, and a small miss on base management fees.
And hence you get a painful drop in Blackstone shares. I spoke with the president and CEO of Blackstone earlier, Jon Gray. I asked him about the reaction in share prices, and I asked him about the overall deals environment. Take a listen.
We've been an advocate of letting this tariff diplomacy play out. Obviously, around Liberation Day, there was a lot of concern, but ultimately we saw progress and deals being made by the administration. I would expect that will continue to happen. There will be noise as the negotiations go back and forth, but I do believe this will settle. And I don't think 6-12 months from now, this will be on the front page. The other thing I'd say around inflation is that our data is pretty encouraging in certain areas. Rental housing, the biggest component in CPI, our data says it's running about half of the 3.6% what the Bureau of Labor Statistics produces, and that should be helpful for the Fed. Also, we've seen a cooling in the labor market. If you look at hourly wages at our portfolio companies, they're down around 3% from north of 4% a year ago. So I think that should allow the Fed to continue to lower rates. That's a positive. So I think some settlement of the tariffs, continued good data on CPI and rates coming down should be helpful. And overall, that environment does feel pretty good. Obviously, there can be risks along the way. We're in the midst of a government shutdown that can slow things like IPOs in the short term. But when we look out over the horizon, it feels pretty good for deals.
So you're an optimist, and there is clear robustness there, Jon. But you and your private capital counterparts, the shares of your companies have really been punished this year. Virtually all have underperformed the wider market. What do you think is behind those fears, and is any of it warranted?
Well, it's hard to look at stocks day to day. We focus on the long term for our shareholders. I think our total return is something like 3.5 times over the last 5 years, double the stock market. So shareholders have been rewarded for investing with Blackstone. We, of course, are very aligned with them as the largest shareholders of the company. I think in markets, when people are nervous about what's happening, there have been a lot of these stories around private credit, which I'm happy to talk about. That may have created concern. Maybe people have been focused on the government shutdown and the IPO market slowing or the tariffs causing that. We tend to take this longer term approach. And when we do that, it looks like a very bright environment. So I think with us, what we found is we just keep executing, keep delivering good returns for our customers. That enables us to raise money, to expand our business. And I think shareholders will see that this business can continue to grow and deliver.
Well, let's get into the private credit of it all, John, because it feels like not a day comes by that someone, admittedly not in private credit, comes on this show or others and say private credit is a troubled child, and bankruptcies with some prime auto lenders are exemplary of that. Why do you push back against that idea?
Well, we would say that if you look at the three big troubled credits that have been out there the last couple of weeks, this is not a private credit story. These credits were bank-led, they were bank-originated, they were bank-syndicated. So we can't really understand why there's a referendum on private credit. I would also point out that these were non-institutional borrowers. If you look at what we do in our $150 billion direct lending business, we lend 98% to private equity sponsors, to public companies. These were individuals. And also, it appears, based on the reporting, that there was fraud involved in these three situations. That's something that's not so common. So I don't think it says really anything about private credit. And I also, because of the idiosyncratic nature of the facts here, I don't think it says a lot about the overall health of credit in the system.
But John, couldn't you make the argument that these were firms that were tapping the credit markets over a span of years, and you had very reputable people coming in and lending to them? Does it not say something, that very fact, that despite this continued concern of financial impropriety, that people continued to lend to them and didn't spot some of the warning signs?
Well, clearly in these situations, there should have been more concern registered. When you go through a period of very low defaults, there can be at times people relaxing standards. And maybe that was the case in these situations. Although in defense of the folks who lent here, fraud, not disclosing liabilities, double pledging collateral, those are hard things to catch. And so that, to me, is a little more understandable. And I do think you have to look at this in the scheme of overall credit. Look at what's happening in the banking system. Their defaults continue to be very low. The realized loss is very low. It's a similar story in private credit. So in aggregate, the system to us feels very healthy. There will be these one-off situations. And certainly as you get deeper into a cycle, could you see defaults go up or losses go up off of these very low base today? Yes. But overall, again, I think the system feels pretty good to us.
What about returns? It had been lauded as the golden age of private credit, but John, as rates start to come in, just performance-wise, is it still the golden era?
Well, I still think it's a very good time for private credit. I would acknowledge that as base rates come down and as spreads tighten, some of the very high returns that were achieved being a senior lender in private credit, that's harder to do, achieving mid-teens returns. But the premium relative to liquid credit, what you get in leveraged loans and high yield, that's enduring because you have this farm-to-table model. You're bringing investors right up to borrowers and knocking out a bunch of origination and securitization costs. And so I think the key thing is not necessarily the absolute return, but can you deliver a premium return over liquid markets? And that I continue to have very high confidence in. And that's why I think we'll continue to see flows into private credit, not just non-investment grade, but investment grade. What we're seeing with insurance clients, the momentum in that area is pretty remarkable because insurance clients recognize, particularly as base rates and spreads come down, that getting that extra return from private credit without taking on any additional risk, that makes a ton of sense.
That was Blackstone President and COO John Gray speaking with me following the company's strong third quarter earnings report. They're probably happy that some of the noise around like the cockroach thing has calmed down heading into this. But anyone you speak to in this industry comes out with really fierce defense, saying it is not a private credit problem. It is banks that did the lending. It's banks, the regional banks that had issues last week too. But as he was talking, he had this idea that Mark Rowan was also talking about, that it is late cycle. When it's late cycle and there's a lot of money in the industry, mistakes are made. Sometimes underwriting standards get a little bit more lax and things like this pop up.
Yeah, I saw Henry Kravis from KKR did an interview with Francine Lacroix and said not $1 of private credit was lost in those two big bankruptcies, Tricolor and First Brands. Maybe there aren't cockroaches there.
Yeah.
Maybe they're only in the banks.
He did have a good metaphor. He's worried about people who do private credit that don't have, I think, a driver's license is what he said. So he does seem to acknowledge that maybe there's some bad actors in the space.
Well, maybe you have to be a qualified investor. Okay, still ahead, we're going to discuss the private credit debate playing out on Wall Street with James Reynolds of Goldman Sachs Asset Management. This is Bloomberg Open Interest. Let's get a check on the stock market, looking at the S&P 500 with the move screen on the Bloomberg. You can see that we're pretty evenly split in terms of the breadth. 238 stocks are gaining, 264 are down. And although the breadth is to the downside, we're up about 16, 17 points right now at 67.15. You can see we dipped down and came back up. You've got NVIDIA firmly in the green right now, up 0.75%. Broadcom, Amazon, Apple, Meta, and Alphabet, as well as Microsoft and Oracle. So all of those big tech companies up, except for Tesla. Tesla is a loser today, down 3%. So is IBM. And then you've got Blackstone down 5.5% as well. Coming up, American Airlines stock soars after delivering better than expected results. We'll hear from the CFO, Devon May, next. This is Bloomberg Open Interest. One of the stocks moving higher this morning on earnings is American Airlines. The company said it now sees a profit for this year compared to a previously predicted loss. Let's head to Fort Worth, Texas, where Devon May, the CFO of American Airlines, is joined by Surveillance co-host Lisa Abramowitz. Lisa?
Thank you so much, Matt. I really appreciate it. I am here in the Dallas-Fort Worth area, and I've learned it's very important to say that, here with Devon May, the CFO of American Airlines. Thank you so much for being with us on this day when you do report earnings. I want to start with this forward look. Things were weaker earlier this year. You do see a real acceleration in demand heading into the fourth quarter. Where is it coming from specifically?
Yeah, well, and thanks for being here in Dallas-Fort Worth. We're coming off a third quarter. We posted a loss this morning, but like you said, we started to see some softness in demand just given the economic uncertainty that really hit probably in February. Led to some softness in the first quarter, through the second quarter, into the first part of the third quarter. But within the third quarter, we started to see some really nice trends. July was soft, August was better than July, and then our year-over-year performance in September actually turned positive. So really happy with the unit revenue we had in September. That's continuing here in October and fourth quarter right now. We're projecting flat unit revenues. What we're really excited about, though, is our profit forecast. We about doubled it today with the guidance we provided this morning.
And there's a lot of focus on the premium cabin is really driving something like 50% of your revenue or that particular gain. I'm just wondering how much that really has been the driver or how much economy has also picked up in tandem with what you're seeing in the business side of things.
It's both. Like we've said, kind of throughout this period where demand was a little bit softer, premium revenue held in there really well. Probably dipped a little bit, but held in quite well. On the lower end, for our lower income earners, that level of demand just really started to fall off. That has come back as well. We're also seeing supply and demand come into balance. So at this point, premium is doing better. The main cabin is doing better as well. And supply and demand's in balance, which allows us to get closer to flat unit revenue.
Have you had to cut prices for economy class to really come back in terms of volumes?
We did, and you saw it throughout this year. Pretty much every airline out there was posting negative unit revenue. So unit revenue's down year over year. That's really because of the fare environment. If you look at real fares, they're down this year versus last year. They're down last year versus the year before that. So we haven't had the type of pricing power we needed. That's starting to come into balance, and it really happens with a couple of things. One, supply and demand has to be in balance. That's happening now in the fourth quarter. We're also seeing that you have to have the right product for your customers, products that customers want to buy. We think we have those types of products with our network and the premium services that we offer.
How much do you expect prices to increase?
They're going to go up, hopefully in line with inflation next year, potentially more, just given how depressed the first half of 2025 was. We haven't seen real airfares grow for a while. A lot of other products have grown. Your Uber tends to go up a fair amount. Your airfares are going down right now. We need to get airfares going up again. I think that happens in 2026.
One thing that American pointed out that I found to be a pretty shocking statistic was that business travel is still below where it was in 2019. Do you see it ever really returning to those levels, or did Zoom fundamentally transform the backdrop?
Yeah, I don't know that it ever gets back to 2019 levels just in terms of total passenger volume. But we are seeing a nice pickup in revenue. And for American right now, there's two things happening. One, business travel is picking up to some extent. And additionally, we're doing a better job getting more share of that traffic. A couple of years ago, we changed our distribution strategy. It didn't work as well as we would have liked. We've reversed that. And we're doing a really nice job right now recapturing a lot of business share. And you saw in the third quarter, our business traffic was up about 14%.
Yeah, one thing that you said in the earnings is that American share of total business travel is 3% below where it was before that change in strategy. What are you doing to bring back that business traveler?
Yeah, well, there's a lot of work happening across our commercial organization. It starts with running a great operation, with having really great customer service, the products that customers really want to have. More tactically, though, we've increased the size of our sales staff. We've been working really close with our corporate partners to make sure that their travel is coming back our way. And it's been really well received. Like, these are companies that want to be flying American Airlines. We just have to have the product in place, and we're doing a nice job with that now.
The product has to do with the plane. I know that that's something that you've been very focused on. You said that there are 50 deliveries of new planes, new jets that you're on track to acquire this year, 59, I believe, next year. I'm just wondering, do you foresee that number going up, that actually you could, because there is this acceleration of production from Boeing, increase some of that that delivery?
Yeah. You know, it's interesting. We look back, and what we've been doing for the past couple of years is putting a bit of a buffer. So if the manufacturer said they were going to deliver on a certain day, we'd put a buffer in that before we actually put it into schedule, just so we weren't out there disrupting customers if that airplane ended up coming late. Given how well they've been doing lately, we don't put a buffer in there anymore. We expect Boeing and Airbus to deliver on time. They're doing a really nice job of that now. And so as we look out to next year, we expect them to deliver on time. I don't think it changes our capital profile or the number of airplanes we have, because we pulled that buffer out about 6 months ago.
There is this feeling right now of how do you weigh the investment in new planes and upping some of the quality that people have when you talk about the optionality versus paying down debt versus creating an even bigger buffer should there be more turmoil in the economy. How are you weighing that?
You know, a lot of our fleet decisions are really long-term decisions. We have the youngest fleet in the industry right now. We have a fantastic product across our fleet, but you have to make the right investments for customers. So we'll continue taking new airplanes. We will continue to invest in our fleet. And then after that, we'll use our free cash flow. So after we've made these right investments in the business and taken care of our team members, then we'll use free cash flow on the balance sheet. And that's what we've been doing for the past several years. We made a ton of progress on the balance sheet. We were at $54 billion of total debt in kind of peak levels of COVID. We've brought that down to $36.8 billion at the end of the third quarter. We have a target here in the next year and a half or so of getting that inside of $35 billion, and we're well on our way there.
One thing that people have talked about going forward is just what you see with respect to the government shutdown and some of that uncertainty. A lot of airlines have said that so far they haven't seen it. Is that something that you would agree with?
Yeah, I would agree with that. You know, two areas. One on revenue. There's not much of a revenue impact. There's something there, but it's definitely less than $1 million a day. The next thing you look at is the operation. Is anything happening with the operation? And so far, while there may have been a couple flare-ups here and there, for the most part, we have been running a fantastic operation in the month of October. And, you know, really credit to all of the government employees who support the aviation infrastructure. They're coming to work every day, keeping everything secure and safe. We appreciate that. We expect Congress will get back to it and reopen government here.
Just the reason why we love talking to the airlines, and in particular you, is because you have the best barometer, real-time barometer of the consumer in America at a time where there's a government shutdown and we are not getting any of the real-time data.
Right.
What other airlines have said is that there has been a reacceleration in the economy from what they can see with respect to consumer demand. Would you agree with that? Is it pretty much across the board a reacceleration, or is there something funky about what you're seeing in terms of the type of demand, the types of consumers that are traveling?
Well, we're seeing really nice demand right now. And for sure, if you look back kind of first half of the year, right up until that first week of July, demand looked pretty soft. But then there was this reacceleration as there was a little bit more certainty in the economy. And to the point earlier, there was a bit of a bifurcation in demand. Higher end, higher income consumers continue to spend. Lower income consumers backed off of travel a little bit. What we're seeing right now is really nice trends from the higher end consumer, a lot of premium traffic coming in. And then at the lower end, that traffic's coming back really nicely as well.
So you also see a reacceleration?
Absolutely, yeah.
Devon May, CFO of American Airlines, thank you so much for taking the time with us today.
Thank you, I appreciate it.
And I'll send it back to you, Matt.
All right, Dani, thanks very much. Sorry, Lisa, thanks very much. She's sending it back to Lisa.
You can also thank
She's sending it back to Dani.
want.
Yeah, there's a bunch of us here, but we were all happy to listen to Devon and get his take on the consumer, and airlines have been just crushing it lately. Some of them have been really crushing it.
I mean, he there said that he expects fares to go up. Of course, the rub is that on the main cabin, they did have to cut some ticket prices to get people in, but it doesn't matter maybe because business travel is so robust and people willing to spend for business class seats too.
Yeah, and upgrade if they're not in the business seats. Let's get a look at some of the market moves that we're watching. Here is American Airlines. You can see up 3%. So AAL doing well on a day when the rest of the market is up marginally, right? We see the S&P right now up 1/3%, the NASDAQ up 0.6%. But American Airlines has a lot of ground to catch up on. This year, it's down 28.5%, even with those gains.
Yeah, the Deltas and the Uniteds with those really robust loyalty programs have done better. By the way, interesting to see that stocks are even able to be positive given that oil is moving so much higher, and that means treasuries are moving higher too. That not pressuring the market, nor is Tesla earnings overall bringing the market down.
Yeah, Southwest Airlines is another one that posted a surprise profit in the third quarter. It said it expects record operating revenue for the final months of the year, but that hasn't helped its shares, down almost 6%. And this could be other details in the earnings report, but as you point out, when you have oil up 5%, obviously fuel is one of the two major cost inputs that these airlines have to deal with, the other being.
I also think, isn't it Southwest that just introduced a fee for baggage too?
Yeah,
so you're
that's
gonna
why.
Have to start paying. Yeah.
And that's why they had that adjusted profit.
Right. But again, that's unfortunate. Who wants to pay more fees for bags? Like, I mean, everyone keeps adding stuff on top of each other.
If you're booking like luggage class, right,
Yeah.
you have to pay for bags. I flew, United over the weekend,
Right.
and I had to pay for each bag that I wanted to check. I had the lowest cost fare, so I couldn't even bring a carry-on.
And you have the kids with you too. That's like itself at least.
One of my kids was a carry-on, yeah. Honeywell raised its full-year profit outlook as it plans to spin off its advanced materials unit later this month, and Honeywell up full 7% in this market.
And quantum stocks, they're climbing. A report that the Trump administration could get equity stake in exchange for federal funding. Iconic up as much as 12%. D-Wave up 22%.
Coming up, we're going to talk private credit with James Reynolds of Goldman Sachs Asset Management. This is Bloomberg Open Interest.
I still think it's a very good time for private credit. I would acknowledge that as base rates come down and as spreads tighten, some of the very high returns that were achieved being a senior lender in private credit, that's harder to do, achieving mid-teens returns.
You keep hearing this argument between banks on private credit and private credit managers. I think both can be true, which is private credit can disappoint. I think that's what the banks are saying. And maybe there are managers that will disappoint given the proliferation of the asset class. And banks are trying to protect their big profit pool on high yield and leveraged loan underwriting. So I think both those narratives can be true. It's not one or the other.
Two titans of private credit, both saying that maybe returns for the industry as a whole won't be as good going forward. Let's add another titan of the industry, another voice. It's James Reynolds, Global Co-Head of Private Credit at Goldman Sachs Asset Management. James, thank you so much for coming in to see us.
Thank you.
I know you're in the middle of your alternative summit, so thank you for letting us drag you away. It is something you hear more, that there's not something systematically wrong with the industry, but maybe returns might disappoint going forward. Is that a real risk right now?
I think that's right, and we've been saying it for some time now, that you're going to see dispersion of returns. The industry is relatively new. Very few players in the industry were there, in the 90s when we started or during the financial crisis. A lot of these players came post-financial crisis, and for the first decade, the environment has been relatively benign, right? Quantitative easing led to obviously maybe capital structure that are no longer fit for purpose. And so I do think that what you're going to see, rather than being systemic risk, is more around dispersion of performance.
So is the reason, like the same reason we see in public credit markets, very, very tight spreads, that just so many dollars are chasing the same product?
I'm not sure that's necessarily the case because all capital is not created equal. I mean, if you go back to private credit, what are the success factors? You certainly need a very powerful origination engine, right? You want to see all the deals out there. You want to see them at inception when, it's still an idea. And then you want to be very selective, right? So I don't think that's the case. I think there's still value to be had. We're very constructive about private credit.
You just need the best managers, is what you're saying.
No, you need to be selective, right?
Is it though harder to be selective? And in my mind goes to something that Mark Nachman said recently, basically saying that with all of the assets coming in, especially as wealth gets more popular, you have ICs overruling deal teams because they're like, you have to deploy. This money needs to be put to work. Is that happening now?
You never want to be forced to deploy, right? I mean, you want to create an investment culture. You want to create a culture of risk management where people, can voice their opinion, and we celebrate when collectively we decline an opportunity, right? I mean, this is what we do. We only make about low single percentage at the end of the year of all the opportunities that we get to work on.
I know you don't want to speak ill of your competitors, but you're confident about that. And some of the deals you see getting done, does that play in the back of your minds that maybe people are being forced and pressured to deploy and get deals done
Others,
at the sake
not
of
you.
Yeah, at the sake of quality?
I think time will tell. That's the beauty of our industry, is that eventually time will tell. Certainly, we continue to have the same discipline. We're not forced to deploy. You also want to have a very balanced funding source, right? I mean, if I think about our platform established almost 30 years ago, we have a lot of institutional capital. It's patient, it's long-term, it's in closed-end vehicles or SMA formats. And they quite like when we decide, we're going to modulate and pace and slow down our investment activity. What you need as well is a very diversified platform. I would say global diversified platform. We started in Europe in 1996. We've been a major actor in private credit for almost 30 years. And sometimes we see better opportunities in a particular region or in a particular asset class. And that's, having that ability to move around, I think it's actually very critical.
So if you're better at selecting, if you're smarter, better managers, and you have a platform with more experience, you can better serve your clients. Can you also charge a premium for that and better serve your bank, your shareholders?
I think, look, the premium and the fees that we're charging, eventually, we've seen fee compression in the industry, right, in terms of how much, we can negotiate also with our LPs. Institutional capital and kind of wealth management, slightly different vehicles as well, slightly different fees. But I would say what really matters, we talk about returns, but you should look at returns post-default and post-losses. That's really what matters. I mean, the alpha in what we do is generated by the lack of losses.
You talk about working with your LPs and the importance of that source of capital. But for many people, they have the sense that wealth is going to grow enough that it dwarfs that of the LPs. Is there a lot of discontent among those institutional investors, this idea that at some point, maybe they become less important to GPs, that they become less important of a player?
As far as we are concerned, and I spent the last 3 days all day long with some of our largest investors, they're very happy here. And by the way, this was very timely given the narrative.
Well, presumably they're happy at GSAM, but in general, is there a sense of discontent that industry-wide that wealth is growing and threatens maybe their standing and their importance?
I think that's why, if you speak to them, I think they're going to be very discerning about the platforms and the managers that they want to be associated with and partnering with, right? There's going to be more of that going on from here onwards.
James, great to get you in the studio. I'd love to have you back again. James Reynolds of Goldman Sachs Asset Management talking to us about private credit and their business at GSAM. Coming up, Wall Street bonuses are expected to hit record highs as profits soar at the big banks. We'll have the numbers for you next. This is Bloomberg Open Interest.
So we always do an annual report this time of year on the securities industry in New York City. And what we find for the first half of this year, profits of $30 billion. So when you consider last year, for the total year was about $49 billion, we could be headed for a record. If the current trends continue, we could be talking about profits of $60 billion this year.
And that was New York State Comptroller Thomas DiNapoli speaking earlier on Bloomberg, saying Wall Street's bonus pool could break records if current trends continue. Joining us now is Bloomberg finance reporter Catherine Doherty. So good news for a lot of our viewers here, and that's because they've done so well in terms of results.
That's right. I mean, we've been reporting now for the third quarter and what we expect the end of the year to trend. It's not just about 2025. Let's be clear. 2026 looks like we're going to be starting off the new year with positive momentum. We hear executives on all the earnings calls and since their results, which were just a week ago, talking about the pipeline and how deals are back. And they're not just returning, they're here to stay. And we've seen much more IPO activity. We're seeing more equity and deal debt issuance, which is helping these bankers. And as far as traders go, we've seen the volatility help trading desks across the board. So this is likely to translate into very, very positive, higher profits at the end of the year for the banks, which will then translate into higher compensation for their bankers.
It wasn't that long ago, really the first half of this year, that usually what you'd hear from the banks when it came to their employees is we're looking for ways to slim down. We're looking at ways to trim our workforce. Is that conversation now over then?
What was interesting was the conversations about expenses. Some of the banks reported higher expenses last quarter, and the executives talked about the fact that they need to keep their best employees. So if you have positive deal momentum, you're working on more deals, you want to retain your best talent so that that can continue. You don't want to see people go to other and into different industries or different parts of banking that they might take their skills and look for higher paychecks. If at the end of the day, you as a bank are reporting higher profits and then that's not translating to compensation for your best people, that's not going to be not going to be translated very well. They will leave.
So we know who's doing well, right? Because of the M&A boom, because of the massive amount of trading profits, who's not going to get a big bonus? Is anybody left out?
So when you look at, you're right, outside of the core Wall Street performance, when you just think about trading and investment banking, you have asset management, you have the hedge fund industry. This is being broken down, but I would say that the latest report that we saw from Johnson Associates, which is also very closely tracked, they had at the beginning of this year put out very modest or even negative projections for the year in terms of compensation, but they changed that across the board. So it wasn't just the core Wall Street trading investment banking that they saw positive momentum. There was an uptick across the industry, across financial services. So we're going to wait to see what that looks like. There's going to be an update before the end of the year. And then as we start to see the actual numbers come out, we'll continue to update those, and we'll be tracking these reports very, very closely.
And we can't wait to have you back to update us, Catherine. Thank you so much, Bloomberg's Catherine Doherty. All right, coming up on the show tomorrow, Emily Bowersock-Hill of Bowersock Capital and Maria Waitman of State Street. Plus, we'll have the CEOs of Scout Motors and Venue. All of that coming up tomorrow. This is Bloomberg.